Welcome to the Deep Dive. We're here to unpack the big trends and, well, distill them into insights you can actually use. And today, we're diving headfirst into the crypto market. It's been pretty active lately, wouldn't you say?
Oh, absolutely. Buzzing is the word.
Yeah, we've seen Bitcoin pushing, 19,000? Ether up around 2,600, XRP jumped about 4%. And the general feeling seems, I don't know, quite positive, almost ignoring those recent tariff headlines.
It does seem that way. There's a definite undercurrent of optimism.
But look, the real story isn't just those day-to-day price moves. Our mission for this deep dive is to get beyond the headlines. We want to unravel two really significant and I think interconnected trends that are reshaping crypto and its link to traditional finance.
Okay.
First, there's a major move by Ripple right into the heart of institutional banking. And second, this explosive rise of what people are calling Bitcoin treasury companies.
Right. Two huge shifts.
Exactly. And the goal is to make sure you walk away really understanding the core insights here and why these developments are so important, whether you're already deep in crypto or maybe watching from the traditional finance world.
And what's really illuminating, I think, is how these aren't just isolated things happening. There's signals, right? Powerful signals of crypto getting, well, more deeply integrated into the mainstream.
Okay, so where should we start? Ripple.
Yeah, let's start with Ripple's big institutional play. The huge news recently was Ripple picking BNY Mellon, Bank of New York Mellon, as the primary custodian for the reserves backing its stablecoin.
It's US dollar stablecoin Ripple USD.
That's the one.
BNY Mellon. I mean, that's a titan of traditional finance. So beyond just the name, what's the fundamental shift here? What does this partnership really represent for crypto?
Well, the core insight isn't just, oh, a big bank is involved. It's that BNY Mellon, acting as a custodian for stablecoin reserves, that sets a whole new precedent. It's about institutional legitimacy for crypto.
Legitimacy, okay.
Yeah, Brad Garlinghouse, Ripple CEO, he really emphasized this. He said, partnering with, and I'm quoting here, the most trusted, well-regulated, and best capitalized partners like BNY Mellon is just crucial, absolutely vital for building confidence.
Confidence, especially after, well, didn't he mention some headwinds previously?
He did. He pointed specifically to what he called attacks on the industry from the previous administration. He sees this partnership as proof of the need for, ironclad trust.
So cementing trust, building legitimacy, does it also help on the regulatory front? Does it make things smoother for Ripple, maybe other stablecoin issuers too?
It absolutely should. This partnership is expected to really enhance regulatory compliance for Ripple, kind of solidify its position.
Okay.
Garlinghouse actually views this whole thing as a clear shift of tide. He said the previous headwinds are becoming tailwinds.
Tailwinds, suggesting growth ahead.
Exactly. He sees a lot of growth coming. And the significance for you listening is that this really boosts the credibility, the institutional credibility of the whole stablecoin sector, which is growing fast, by the way.
Right.
It bridges that gap, between traditional finance and crypto in a way we haven't quite seen before at this scale.
That's a really big step, integrating crypto into TradFi, not just alongside it. Okay, let's pivot then to the other major trend you mentioned. Traditional companies putting crypto, specifically Bitcoin, onto their balance sheets. This Bitcoin treasury accumulator trend, you said it's exploded recently.
It really has. Exploded is the right word. Now, Michael Saylor's MicroStrategy, they famously kicked this off way back in 2020.
Right, they were the pioneers.
Definitely. But the acceleration lately, that's what makes it feel like such a new phenomenon. It's gained incredible momentum.
So why now? What's changed?
Well, the key insight here, I think, is the regulatory environment. Shifts there seem to have made companies feel, well, safer about following MicroStrategy's lead, more comfortable adopting this strategy.
Ah, okay. The regulatory picture getting clearer, or at least less threatening.
Something like that. And it's triggered this huge emergence of new players, especially over the last 12 months or so. We just saw, for example, Sequans, a company out of France, announce a $384 million raise.
Wow.
Yeah, specifically to fund its Bitcoin treasury. So that just shows you the pace of adoption is really picking up.
Okay, but MicroStrategy has such a massive head start, right? Billions in Bitcoin, huge market cap. Is there really room for these new players? Isn't the market getting saturated?
That's a great question. And it's fascinating because you're right, MicroStrategy is kind of in a league of its own right now in terms of scale.
The only one, really.
Pretty much the only one that's achieved significant scale, yeah. We're talking a $120 billion market cap, over $6.5 billion in Bitcoin on the books.
So definitely not saturated, though.
Not at all.
Right.
There's really just one giant player.
Yeah.
And here's where it gets really interesting for investors. They're now actively looking for that next MicroStrategy, that hyper-growth opportunity that MicroStrategy offered early on. They feel like maybe they missed the boat on that initial run.
Right, trying to find the next big thing. So how are they identifying these potential winners? Are there specific metrics they're looking at?
Absolutely. One key metric that's really emerged around these treasury companies is something called Bitcoin yield.
Bitcoin yield. Okay, what's that?
It essentially measures how quickly a company is accumulating Bitcoin per share.
Ah, I see. So not just how much Bitcoin they have, but how fast they're adding it relative to their shares.
Exactly. And savvy investors are using this Bitcoin yield metric to spot promising newcomers. And we're seeing capital start to rotate, moving into these newer firms, hunting for those potential 5 or 10x opportunities.
That makes total sense, chasing that yield, that growth potential. So who's actually investing in these companies? Is it just the crypto crowd, or is it broader than that? How has access evolved?
It's definitely broadening out. The appeal is that these companies are launching actual securities, things that institutions and regular retail investors can buy.
Okay.
For the big players, like MicroStrategy, a huge chunk of the investment comes through institutional channels. You have to think about that massive, $100 trillion pool of institutional capital.
Wow, $100 trillion.
Yeah, and most of it is restricted, right? They can generally only allocate to equities or maybe credit products.
Right. They can't just buy Bitcoin directly in many cases.
Precisely. So these Bitcoin treasury companies, because they hold Bitcoin but issue equity or bonds, they can essentially securitize around that balance sheet. They create products tailored specifically for those institutions.
That's clever. So it's like a wrapper, a traditional finance wrapper around Bitcoin exposure.
That's a good way to put it. And it unlocks access to potentially huge amounts of that institutional money.
So is that where most of the money is coming from now? Institutions. What about retail?
Retail is still very active, definitely, especially in things like derivatives for maybe more high-octane Bitcoin returns, or just, FOMOing in to the new equities when they launch.
FOMOing, yeah, we see that.
But the institutional side is where the scale is shifting. Initially, a problem for these treasury companies was scale, and liquidity institutions need that. But that's changing. MicroStrategy, for instance, is often in the top 5 for trading volume now. So it's becoming more accessible.
Right. And that evolution opens up broader opportunities, as you said, allows institutions to tailor their exposure.
Exactly. And the new guys, the new entrants, they're not just waiting to grow organically like MicroStrategy did initially. They're using things like PIPE deals.
Private investment in public equity.
Right. And convertible bonds. Basically ways to raise significant capital and achieve scale much faster.
Okay, so they're getting bigger faster and attracting both institutional and retail money. But this brings us to something you touched on earlier, which sounds almost counterintuitive. You said these companies are designed to outperform spot Bitcoin itself. How? What's the strategy there?
Yes, this is probably the most crucial strategic insight. Their fundamental design involves using leverage. They apply leverage against the Bitcoin they hold on their balance sheet.
Leverage. So borrowing against their Bitcoin.
Essentially, yes. And that creates this heightened sensitivity on their balance sheet to Bitcoin's price movements, both up and down, of course.
Okay, so more sensitive to price swings. But isn't Bitcoin's volatility usually seen as a risk?
But here's the key reframe. For these companies, the volatility, Bitcoin's inherent price swings, is no longer a risk. It's the core engine that's driving everything.
The engine. How?
Well, think about it. You combine that volatility with Bitcoin's historical growth rate, let's say 20-30% compound annual growth historically.
Right.
That combination allows them to effectively jumpstart their strategy. The leverage amplifies the gains from Bitcoin's overall upward trend, fueled by the volatility along the way. It's designed for outperformance.
Wow. Okay, so volatility becomes an asset, not a liability. That's a really different way of looking at it. Are all these products then super aggressive, aiming for maximum outperformance, these high-octane returns you mentioned?
Not necessarily. That's part of the evolution. While some products are geared towards that maximum outperformance, the playbook has definitely diversified.
How so?
We're now seeing the introduction of things like fixed income products, bonds issued by these companies. These are tailored more towards yield-focused investors, people who maybe want some Bitcoin exposure, but in a more traditional, perhaps less volatile, income-generating format.
I see. So there's a spectrum now, from aggressive growth plays to more yield-focused options.
Exactly. There are customized exposures being created to fit different investment mandates and risk appetites. It's becoming quite sophisticated.
This strategic thinking, this sophistication, it really ties into the deeper why, doesn't it? Why Bitcoin is gaining this traction in the first place. You mentioned Swan Bitcoin seeing significant interest lately.
Yes, Ben Workman from Swan noted a real surge, particularly in the last 4 months or so. He pointed to an education gap and maybe a talent gap in the market that these Bitcoin native companies are now filling. People are getting more curious.
Right. And if we zoom out, thinking about the big picture for you, our listener, it seems like people might initially come looking just for price exposure, right? I want to buy Bitcoin.
Often, yes.
But learning about these kinds of equities, these treasury companies, it leads them to evaluate Bitcoin itself more deeply, the underlying commodity, as you put it.
That's exactly what seems to be happening. It prompts a deeper look. And that inevitably brings us to what many see as Bitcoin's core utility today, its potential ability to outpace monetary debasement.
Monetary debasement, that sounds serious.
It is. And it's not just some abstract economic theory. It's a real problem that individuals, companies, even entire nations are grappling with globally. Currencies losing purchasing power over time.
And we see examples all the time. You mentioned a new spending bill, potentially adding, what, $3 trillion to the deficit?
Exactly. These kinds of actions highlight the issue. It can feel like there's an almost unlimited supply of a currency being created, often to meet obligations.
So people see their savings, their earnings being devalued.
Precisely. And in that kind of environment, investors, savers, everyone starts looking for an alternative, something that holds its value or even increases it when currencies are being debased. They start looking for the opposite of unlimited supply.
And that's where Bitcoin comes in, with scarcity.
That's the core argument. Bitcoin offers defined scarcity. There will only ever be 21 million Bitcoin. Full stop.
That supply is fixed, capped forever.
It's inelastic is the technical term, meaning no matter how much demand increases, demand could be infinite. Theoretically, the supply will not increase to meet it.
So if supply is fixed and demand rises...
Price is the only variable that can adjust. Price has to go up to balance the equation.
Right.
And you hear this now. People are actively looking for ways to take that value out of a system that they feel is mistreating them, a system that's devaluing what they've worked so hard to earn.
That's a powerful motivation. Very human.
It is. And increasingly, they seem to be constantly turning to Bitcoin now as the solution for that.
Wow. What a compelling underlying driver for this whole movement, beyond just the investment mechanics. So, just to recap this deep dive then, we've really seen how institutional players are moving beyond just, dipping a toe in. They're actively integrating with the crypto world.
Deeply integrating.
Creating these diverse, pretty sophisticated investment opportunities, ways to get exposure that go far beyond just buying spot Bitcoin.
From stablecoins custodied by major banks to these leveraged treasury companies offering different risk profiles.
Right. Which really brings us to a final thought, maybe something provocative for you, the listener, to consider. How does this whole evolution of treasury assets moving from just cash on the balance sheet to now including Bitcoin, how does that challenge our sort of long-held assumptions about wealth preservation, about corporate finance?
That's a big question. What does it mean for the future of money itself?
Yeah. And what could it mean for your own financial strategy, navigating what feels like an increasingly complex global economy? Something to think about.